All right. So, welcome to your very first day of class with me here at UDC in the Principles of Accounting 1. Once again, happy to have you with us. Y'all can still see my screen, correct? Just to confirm.
Yes.
Okay, thank you so much.
Yeah.
Thank you, thank you. Okay, so this is the classroom as you see it. It looks like this. Sorry, sometimes it takes a second. It looks like this. You'll notice I post announcements very regularly to keep you informed at all times about what's going on in the classroom. This is also where I'll post the recordings. I also will send you messages on a pretty regular basis, just to continue to check in. Right, very very important. If you come to the classroom homepage, I want to show you a couple of really important aspects of the classroom before we jump into the syllabus. Under the Start Here module, as the name implies, I do want you to start there. And I'd love for you to go through all of these just to kind of check everything out, okay? Um, and I see some of you have been in the introductions. I appreciate that, definitely. Uh, we're going to talk about the syllabus here in a second, but just below the Start Here module, I built this really cool Chat GPT tutor for you. It's a tutor bot. Okay, it took me months to develop this thing, but it acts just like a real life tutor would. So if you ever are curious, like, hey, you know what, Dr. B told me about that accounting equation, and I can't remember what it is, and you could say, what is, just real plain English, what is the accounting equation? It'll come back with that formula, and it'll also provide you with an explanation and concepts. And so ultimately what this is doing is it's helping to reinforce stuff for you, okay? Now it'll ask you engaging questions anytime you want to reinforce concepts. It's there for you. So that's just like a virtual tutor. It's there for you 24 hours a day, 7 days a week. It doesn't take any breaks. It's real nice, and even doesn't even ask for benefits. So that's a fantastic thing about these virtual tutors, right? So I got that set up for you, and it's specifically developed for this class. So I wanted to tell you about that first, so that way you had something to go on. So going back to the Start Here area, I'm going to quickly talk about the syllabus. I just so happen to have it pulled up here for ease of use. This is the same exact syllabus that is in the classroom. So I want to go through some key areas in the syllabus. I'm not going to read all this stuff to you because you all know how to read. So I'm going to show you just the key areas that you need to know. First and foremost, very top, this is technically an in-person class. However, as I had mentioned, your registration indicated both emergency remote instruction and in person. So when we do meet in person, we will meet in room 301 on campus during the same exact times. You'll see down here, this is my contact information. This is my cell phone number. Okay, that phone number is my cell phone number. You can feel free to text me, call me, whatever. But I tell you what, if you text me, tell me who you are and what section of the class that you're in, because I teach more than one principles of accounting class every semester. So please, if you reach out to me, just tell me who you are. That way I can respond. All right. I do have office hours. We can meet on Teams. We can meet on Zoom, whatever, what works for you. Okay. I'm not going to limit you to just the office hours. You can reach out to me via email at any time. It goes right to my cell phone, and I will respond to your email as quick as I humanly can. So that's contact information. This course is an introductory accounting course. We're going to talk about how to develop the financial statements, which include the income statement, balance sheet, statement of cash flows, and the statement of retained earnings. Every business has those financial statements. I'm going to talk to you about how businesses operate based off of the accounting principles. So feel free to read through those course objectives. It just kind of helps to solidify what it is that this course is all about. Quick note, there is a textbook for this course. It is the 25th edition of the Fundamental Accounting Principles. It's okay if you have a used textbook that is the 24th or 23rd edition. It doesn't matter. It's all the same stuff. Okay. The principles of accounting have not changed in the past 2,000 years, and I don't expect them to change anytime soon. So if you have an older version of the book that's used sitting on your desk, totally fine. You can use it. It's not a big deal. If you are a part of the Follett All Access program, where you pay that one-time fee every single semester and you have access to all your books, great news. I have your book right here under the Start Here module. Go ahead and click on that course materials link, and it should, in theory, open up and be right there on your bookshelf. If you happen to be enrolled in Principles Accounting 1 and 2, it might show up twice, but it's there. Okay. So either way, the book, it should be there. If it's not there and you are a part of the Follett All Access program, you might need to click a couple links, but it should show up. If it does not, or if you have problems accessing the textbook for whatever reason, shoot me a very quick email and I'll be happy to connect you with a bookstore manager who I will very aggressively pursue until your problem is solved. So that we will make sure that you have full access to your books. So that's the book in a quick nutshell. But really, honestly, you don't have to worry too much about the book because everything in this class is right there in Blackboard. You do not have to leave Blackboard for any of your assignments, any of your quizzes, exams. It's all right there in Blackboard, so you don't even need to use the I'm sorry, the McGraw-Hill environment at all. Everything is right here in Blackboard. Okay. I will also say that you should, if you don't already, you want to make sure that you get your LinkedIn Learning account set up because this class will have 2 LinkedIn Learning certificates associated with it. Now, what is LinkedIn Learning? LinkedIn Learning is a way for you to earn professional certificates that you can showcase on your LinkedIn profile. And it is very easy to set up your LinkedIn Learning account if you have not done so already. There is a page here under Start Here called LinkedIn Learning Activation. Short video to watch, walk you step by step. It's a very short 9-step process. You start here with your activation, blah blah blah. You'll punch in your or your for your LinkedIn account or your UDC email address. Either one. You'll just follow those 9 steps, and it'll link your 2 accounts, and that's all you need to do for activating LinkedIn Learning. The good news is you don't have to worry about that immediately, but it is something that you should try to take care of this week just to make your life a little bit easier for this course. What else can I tell you? Let me tell you about how you'll be graded. That's always a fun part of the course. So your participation, which involves you being in class, whether we are meeting on Zoom or in person in room 301, is worth 25% of your grade. So make sure that you are actively participating in class. Very, very important that you are present. Yep. There are a total of 15 quizzes or quote unquote homework assignments for this course. They're worth about 10 points each, roughly, or 15% of your total grade. There are 2 LinkedIn Learning certificates worth 10% each of your total grade, or 200 total points, or 20% total. The midterm exam is worth 20%, and the final exam is worth 20%. That's the general breakdown of the point structure for this course. I want to also call your attention to this part right here. Obviously, I'm very quick to do things, so you don't have to worry about me. It's more or less making sure that you meet your deadlines. Now, technically, I don't accept late work. However, if you know you're going to be late with something, let me know in advance. If you're late and you don't tell me in advance, it will be a 10% per day late penalty. Yep. So definitely don't be late. with working the course. Very, very important that you are timely with things. The way I look at that is if you're employed, you're if you do stuff late and you don't tell your boss gonna be upset, and you might get fired. So that's the way I approach school too. I look at school as your job. It's a part of your job, right? It's your responsibility. So timeline is super super important. That's all I want to emphasize on that. The entire course is out of 1,000 points. This is your typical breakdown letter scale grade. Should be the same pretty much every course. The next very important area I want to call your attention to is the schedule. So here we are. We are in week one. We are meeting today. We are meeting on Zoom. Uh, so that is the one time that we're going to meet this week. We're not going to meet on Thursday. The way that I run my courses is that we meet once per week, not twice per week. We meet once per week. So today is our meeting day. We're going to meet every single Tuesday for the whole semester. I want you to be able to use the class time on Thursday to complete the work for that respective week. Does that make sense to y'all? Are y'all okay with that approach?
Makes perfect
Yes,
sense.
sounds
Yeah.
good to
Yeah.
me.
Yep.
Okay.
Yeah, that's awesome.
All right. Yeah, I care about y'all, and I know that y'all have crazy schedules with your home life, your work life, your everything life, your school life. So I want to make sure that y'all have enough time set aside for this class. So Tuesday will be our lecture day. Thursday is going to be do the work day. Okay. So that's how I want you to think about it. Now, take a look at the schedule very, very closely. Today we're meeting on Zoom because it's the first week, right? Next week we're also going to meet on Zoom on next Tuesday. Okay. It won't be until week 3 that we're going to meet in person in room 301, right? So 127 on the 27th, we'll meet in 301. Then back on Zoom, then back in person, then back on Zoom, then back in person. You see where we're going with this, right? So, um, uh, if you can save the syllabus somewhere, I'll send out calendar invites just to make sure that we're all on the same page of whether we're on Zoom or whether in person. Okay. Don't worry, I'll never drop the ball. I'll make sure that y'all are with me. But I just wanted to give you an idea. It's kind of like alternating between Zoom and in person. All right. That's how we're going to balance it out for the semester. So feel free to take a look through that. That is your syllabus. Any questions at all on the syllabus before we jump into week one? Y'all good? Okay, cool. Thank you so much. Appreciate your patience with that. Now I'm bringing you back to the classroom. I want to show you where everything is so that way you're not confused, and you're welcome to follow along with me. So here we are in week one. Every single week is designed the same way. We have a week at a glance, just kind of shows you the overview, what it is that you're learning this week, the learning objectives, all that fun stuff, okay? Now you'll click the next part. It's going to bring you to your instructional materials. This is where you're going to find what chapter we're supposed to be reading and also the PowerPoint presentation that I will be going over during our lecture. So that's a good one to follow along with. And of course, there's going to be couple little cute little extra stuff and some videos I recommend, Then the next folder you're going to see is called exercises. In the exercises, as the name implies, these are ungraded, not required exercises. However, I find them to be very valuable and important, especially for my accounting students in the room. So that first one, we have some Excel exercises for you to practice with. You could download this file and practice with Excel. Excel is always a fun tool and very important to use, especially for employers. The next one, and I recommend this one for all students, is I developed this really cool company. This is new this semester. I wanted to do something really fun, so I created the Firebirds Cookie Company. All right. I can see my catering guy right now, my chef. My chef, all kinds of excited. I can see he's ecstatic. So take a look, chef. I created this really cool cookie company called Firebird's Cookie Company. Okay. Now, every single week, you have these embedded, real cool exercises. It'll give you a scenario, and you'll work on through it. Put your name, go through, and have some fun with this. Okay, this is not graded, but it is designed to help you to really better understand the content in a hands-on learning environment. Okay, this is designed to be hands-on learning. So for you to be able to relate what it is that we're learning tonight to the real world, this exercise, these Firebird Cookie Company exercises that are in each week, promise you're going to have some fun with that. Okay. So definitely get a chance to get deep in it and have some fun. Okay. And then the last thing I want to show you is every single week we're going to have like a short chapter quiz related to the content that you're going to learn. And then some weeks we'll have just a little bit of extra stuff, but that's the way each week is designed. All right. So without further ado, I would love to bring us into that first chapter called Accounting and Business. And I'm not a big fan of the name of this chapter because it's just kind of weird, but because every business has accounting in it. All right. This is like a standard thing. Every single business, you need to know whether you're making money or not, if you're making a profit or a loss. What are your balances on your accounts? All of that is super critical for you to know. So why is it called accounting and business? Every business has it. I don't know. That's just my thing, but we call this accounting and business. So I'm going to talk to you about why accounting is important, who uses it, why we use it, how transactions are made, and how those transactions affect the business. Right? So very basic stuff that we're going to talk about tonight, but I want you to kind of get a grasp of what it is that I'm talking about. And I'm going to use some examples, real life examples that I'll roll through just to kind of make it fun and interesting. So first, I want to talk about why accounting is important and what it really does. The idea of accounting is that it's really an information system. It measures uh, how the business is doing through their business activities. It identifies, records, and communicates the business's activities. That's what accounting does. Very, very basic. Okay. And we do this in three steps. The first thing we do is we identify that an economic event has occurred, a transaction. We record that transaction in a chronological way, and that those transactions collectively are communicated on the financial statements, the income statement, balance sheet, statement of cash flows, and statement of retained earnings. Now, I'm going to give you a really fun classic example here. I'm a big fan of Macy's, the department store Macy's. Now, yeah, I hear you. I know Macy's ain't doing well. All right, I know they ain't. I wish they were doing better, but I'm going to give you an example of Macy's. Now, Dr. B, I'm a big fan of sneakers, okay? I like shoes. I'm a shoe guy. What can I tell you? I like my shoes. All right. You'll see when I see you in person, all right? You'll also see that I like my suits. I like dressing up, okay? All right. So, I go to Macy's. I buy a pair of sneakers for $100. Let me ask you something, and any of you can unmute and answer this question. Let me ask you this. If it cost if I purchased a pair of shoes for $100, how much do you think Macy's paid for that pair of shoes from their distributor? What do you think?
Probably 20%,
I
20,
agree.
50%.
20%, 50%? Who else?
I agree, 20% possibly.
Yeah, yeah. I like that. You guys are smart. Okay. Yeah, Macy's probably paid about $20 for that pair of shoes, sold it to me for 100. Okay, yeah, absolutely. Those are real numbers, by the way.
They probably only paid 20% because they got it at a wholesale price.
Well, I'm glad you said that, Kira. So let me explain to you how real world clothing works. Okay. Oh, this is going to hurt some of y'all's hearts. But let me tell you. Let me explain it. Okay. So here's how it really works. This is the same with furniture as well. Okay. So I really like my clothing. So let's use the example of a red T-shirt. Macy's sells a red T-shirt. They sell that T-shirt for about, let's say, $50. Okay, on the clothing rack. That's retail price. Now we know that Macy's didn't pay no $50 for that shirt. Okay, they're not in business to lose money. So it all goes back to Bangladesh, which is where that shirt was made. All right, so Bangladesh is very well known for making very high quality clothing. Take a look at your tags. All right, take a look at your tags on your shirts and say, hey, this is made in Bangladesh, or this is made in, Cambodia. This is made in Vietnam. This is made in, you know, there's a lot of great clothing manufacturers around the world. A lot of them are located in areas like Bangladesh, Vietnam, Cambodia, and a couple of other countries in that region. Why? Because there's a lot of silk that's grown in that region. Okay, so factory in Bangladesh, they make the red T-shirt that Macy's sells for $50. Now, I know y'all are smart. How much you think it costs to make a red T-shirt? Take a
Mm, a
wild guess.
couple, a couple of pennies.
Probably like,
Oh, pennies?
yeah.
I'm with you.
Probably a couple dollars.
A couple
You say you pay
dollars? Maybe. Kevin, honestly, I think a couple dollars too high.
a
Couple
couple
pennies.
cents. Hmm.
I'm thinking, well, I could tell you, I know how much it costs.
Okay.
Well, if we throw in inflation and other factors, let's use today's dollars. I would say it's probably costs about 25 cents to make one red T-shirt. And it takes maybe about 30 seconds to make it, maybe 45 seconds if the employee is relatively untrained. Um, so for direct materials, which is the thread, we'll say that that's probably 10 cents. For the labor, you're looking at maybe another 5 cents. And then for the overhead, for the factory overhead, you're looking at maybe another 10 cents. So all in, probably about 25 cents per shirt to make it. Okay. Real numbers, by the way. So it costs 25 cents to make it. The manufacturer sells that red shirt to the distributor. The distributor is the middleman. Okay. So the manufacturer sells the red shirt to the middleman for about, let's say, 40 cents. All right. About 40 cents. That's about right. Because the distributor's got cost in it too. They got to get that thing to a ship, into a shipping container, and bring it to the United States to sell to Macy's. All right. It lands. The distributor makes out with a small profit. They sell that red T-shirt that cost the distributor 40 cents. They sell that to Macy's for about maybe 75 cents, roughly. Okay, maybe a little less, maybe like 60 cents. Okay, so Macy's purchases the red T-shirt for 60 cents from the distributor. They turn around, put it on the rack for $50. Okay, so those are real life numbers, y'all. So next time you go to Macy's or any retailer for that matter, you go to that clearance rack and you're like, man, it's 90% off. There's no way they're making a profit. That's impossible that they're making a profit at 90% off. Come on, y'all. They are still crushing it. All right. So,
Hmm.
real numbers. That's how it works. That's how it works. Now, the reason I tell you that story is because in accounting, there were multiple transactions that happened there, weren't there? Yeah. We manufactured it. Manufacturer sold it to the distributor. Distributor sold it to Macy's. All right. Then Macy's sells it to Dr. B for $50. Now, think about that transaction, right? So, what's happening when you go to Macy's? You pick up the red shirt for $50. You bring it to the cash register. You hear that beep, right? They scan it in. What's happening with that scanners are taking it out of their inventory. All right. And it's being registered as a sale to me. So I pay them cash $50. I walk away with their inventory. Now, two things have happened there. Number one is Macy's made the sale, so they're generating sales and they're receiving cash. So they debit cash $50 and they credit sales $50. That's the first transaction. The second transaction that's related to that is the sale of the inventory because they have to reduce their inventory on their books. The way that they do that is they're going to debit an account called cost of goods sold, and they're going to credit inventory for $20. Right? So the difference between the $50 sale price minus the cost of goods sold, $20, we call that gross profit, which will be $30 in this case. But all of those two transactions that stem from one transaction, all that gets recorded in the point of sale or the accounting information system, which eventually makes its way onto the company's income statement. Right? So that is the process of accounting. You'll notice that I use that as one example. There are thousands of other types of transactions out there. Every single business in the world uses accounting. Accounting, we call it the language of business because we need to be able to communicate to our external and internal users of information about what's going on with the company so that way they can make better decisions. We group people into two, external users and internal users. For Macy's, I'm an external user because I am actually an investor in the company. I own some of their shares of stock. I'm a shareholder, okay, through one of my many investments, right? A lot of us have investments that maybe you have Macy's in your portfolio, you didn't even know it's there. We call it a retirement account, right? Your 401k or 403b or your SIP or whatever. There's so many different ones. But in your retirement portfolio, you might have an index fund, and that within that index fund is Macy's. All right. So Macy's affects your portfolio indirectly. Yep. So you're an external user of their information. Now, what I like to do for companies I invest in is I'll go onto the SEC's website and I'll pull their annual reports. And I'll read through their income statement and balance sheet, statement of cash flow, statement of retained earnings to better understand the company's performance. Because I only invest in winners, right? So you want to only invest in winners.
Mhm.
Right, Kiara?
Yes, I agree.
Yes, got to invest in winners. Absolutely. So we break out these users into two, external and internal. External means they're outside the company. Okay, they work outside the company. They interface with the company as either being a shareholder, a lender, an external auditor. Maybe they do work for the company, but they're on the front line, non-managerial, or maybe they're regulators. All right, regulators, that's the IRS or the SEC. Non-managerial employees, front line. External auditors, these are independent accountants that go in and they audit the company's books. Lenders, those are banks. Yep. So all of those use information to make decisions about the company. On the internal side, we got our managers, a whole bunch of different managers, right? You got operations managers, you got HR, accounting, purchasing, production, research and development, marketing, all these different managers. They all need to know about the company's performance, so that way they can make decisions about their individual departments. If they have to pivot or do something a little bit differently in order to mitigate any kind of risk or any kind of loss. But those are the two different types of users of information. Now check this out. This next slide. Holy smokes. Look at all these positions. Wowza. Who would have known, right?
Right.
There's so many different people. You look on the financial side, you got planners, criminal investigators, consultants, regulators, financial analysts, um, people that do preparation work for the financial statements. And then on the managerial side, you got, I used to be a controller. I was one of them. I'm still a consultant. Um, Treasurer, I was one of those for volunteering. A budget person, I've done plenty of those. Cost accounting, general accounting, blah, blah, blah. Then under taxes, you got a lot of tax people going on. You name it, right? And then you got everything related to the field. So if I were to tell you, you think that you don't interact with accounting. You do. You promise you do. I know you do. You just don't, maybe you don't think about it that way. Now, y'all file taxes? That's accounting. Y'all interface with these other services? You're interfacing with accounting, right? You just don't necessarily think about it the same way. But I tell you what, by the end of this course, you ain't going to be thinking about any type of purchase you make the same way ever again. You're going to be like, oh man, now I get what's going on in the back end. Yeah, you understand. So, but yeah, plenty of positions. Not to mention, a lot of these pay pretty darn well. So if you're thinking about anything related to accounting work, I'm telling you, they pay pretty well, and there's a very high demand for a lot of these positions, especially in the DC region. Is a ton of demand. Even with AI, I don't think any of this is ever going to go away. All right. Yeah, you can say that there will be some positions replaced with AI. Yes, of course there will be. But these are like the very repetitive type of positions like data clerk, secretarial work, um, that repetitive stuff like entering transaction data. I think a lot of that's going to be replaced with AI in the future, but not right now. But I'll tell you what this does is it frees up the work of the human to be able to do more, right? So you want to think about AI as your partner, not your enemy. This because you'll be using AI for a lot of your work. You do it right now. I know you do. Even when you write emails or maybe it's helping you with the research on some of your classes, whatever's. I know you're using it, and that's great. I want you to. I think it's a great tool to know. You just have to be very careful with it. Obviously, you need to understand how it works. We definitely analyze a lot of data using AI. What I like to do is I'll take huge Excel files from companies because I ain't got time to sort through huge Excel files. And first of all, I don't really understand what I'm looking at. So it's like, oh, here's this big Excel file. I need to understand what the sales trends are for the company or the cost trends for the company. I ain't got that time. So what I'll do is I'll dump that Excel file into Microsoft Copilot. I'll say, hey, analyze this Excel file. Tell me about the trends. Tell me about the analytics. And it'll draw me some charts and graphs. It'll show me all the trends I need to know about that huge data of information. And then what I could do is I can help to visualize that information. I can put it into some real cute charts and graphs. What I'll also tell you related to charts and graphs is there's so many dumb doctors out there. I tell you what, doctors, lawyers, dentists, all these high-end professionals, they dumb. They are really dumb, dumb, dumb people. What I mean by that is that they're smart when it comes to their craft You know what I'm saying? Like the best dentists in the world, doctors, lawyers, whatever. They're smart when it comes to that stuff. They are dumb when it comes to running their own business. They don't understand the numbers, right? They didn't go to business school like y'all are. They didn't go to be take a class with Dr. B. They didn't take a class with me. So they don't know about their numbers, but y'all will. And you'll be able to show charts and graphs to all those dumb doctors out there and show them exactly what it is that they are missing out on. You see what I'm saying? So it'll be good for y'all to know how to do these charts and graphs. But that's another thing we do in accounting, especially now. Uh, Next thing I want to talk about is really important concept. It's called ethics. Ethics is at the forefront of everything we do in business. You must be a very ethical person, behave ethically, don't steal nothing, don't try to commit no fraud, stay out of trouble, okay? Do all the right things, all right? Super, super important you do the right things, and not only for your life, but also for the success of your future. This is super true, especially with accounting. It's important that we're able to not only behave ethically, but also identify when ethics are being violated, because we have an obligation to the company to ensure that the company's assets are safeguarded. And so we have a fiduciary responsibility to our coworkers, employees, supervisors, customers. We have a fiduciary responsibility to do right by them. And so it's important that you behave ethically and that from that perspective, but also be able to identify when things don't look right. Okay, especially in accounting, you look at the financial statements, income statement, balance sheet, statement of cash flow, statement of retained earnings. You look at one of them, it's like, hey man, something to look don't look right here. Raise the flag. All right. It might not be fraud, but it could be an error, right? That's behaving ethically. Yeah, you definitely want to do those kinds of things. Now, why does fraud happen? Well, there's usually three rationalizations to why these things happen. First of all, there has to be an opportunity for somebody to commit the fraud in the first place, right? The opportunity is, well, looks like they left that safe door open. Ain't nobody gonna notice, right? That's an opportunity. Right? Opportunity to commit the fraud in the first place, that has to exist. The second thing is pressure or incentive. The pressure is like the pressure we feel from home. It's like, oh man, I'm late on my bills. I'm late on my rent. Oh man, what am I gonna do? I'm tight on money. That's pressure, right? So that pressure might cause us to act a certain kind of way, right? So you have to have opportunity and you have to have pressure. But you also have to have rationalization. Oh, everyone does it. It's like, oh, everyone steals a little bit from their plate. No, 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 are you kidding me? But opportunity, pressure, rationalization, you have all these three things together. It's the perfect opportunity for fraud to occur in the company. So we, as good managers, we need to be able to identify the opportunities, the pressures, and the rationalizations to be able to mitigate the fraud from happening in the first place. And that happens with a good set of internal control systems, which we'll talk about in future weeks. So when we look at those aspects, it's important for us to kind of understand how did accounting even start? Who started this stuff? Well, really, it started about 2,000 years ago. Actually, a little longer than that. Accounting has been around since the BC era. It all started from the bartering system. I'll give you a couple of shells for that blanket that you made. Oh, that's accounting. Believe it or not, it's okay. I tracked my sale. I received two shells for this blanket that I made. Um, that's accounting. So in true fashion, accounting actually started over 2,000 years ago, but uh, more modern day accounting, I guess, it's probably about maybe 1,500 years old, thereabouts. So a long time, all right? The accounting principles have been around for the past 1,000+ years, okay? And they really haven't changed much since then. They've evolved, obviously, as technology has, but other than that, the foundations are all the same. So the generally accepted accounting principles is what we use here in the United States. They're used to govern the way that information is being presented in a relevant and faithful way. This helps to ensure accuracy of business results being communicated to investors. Yeah, that's what generally accepted accounting principles are. So the United States uses GAAP, and the rest of the world uses international financial reporting standards. So we'll talk about that here briefly. The U.S. GAAP, generally accepted accounting principles, have been set by the Financial Accounting Standards Board. They're located over on K Street. If you're ever interested in paying them a visit, they're over there. They're really great people, by the way. I talk to them all the time over there on K Street, Financial Accounting Standards Board. They're the individuals responsible for governing all accounting practices here in the United States. Publicly traded companies are governed by the Securities Exchange Commission. They oversee all publicly traded stock and publicly traded companies. They're responsible for oversight for publicly traded companies. These companies are required to be audited once per year by an external auditor. They audit the financial statements to ensure their compliance with generally accepted accounting principles. On the international side, we have the International Accounting Standards Board, which was created by the International Financial Reporting, that they created the International Financial Reporting Standards, which is what the rest of the world uses. The United States uses GAAP, and I think about 6 other countries also use GAAP, and the rest of the world uses the International Financial Reporting Standards. So just something to know. Nothing terribly important there. The Financial Accounting Standards Board framework established these criterion. First is objectives, and is to provide useful information to investors, creditors, and other individuals. The qualitative characteristics, this is the requirement that information should be relevant and faithful. The elements are the financial statements, income statement, balance sheet, statement of cash flows, and statement of retained earnings. And then we have the recognition and measurement principles, which set criteria that must be met when at the time that we recognize revenue and expenses. And we're going to talk a lot about that here in a few minutes. Now, U.S. GAAP, we have a very strict set of principles that we follow. The first is called the measurement principle. This is how we record things at their actual cost. We call that the measurement principle. It's also known as the cost principle. We have the revenue recognition principle, that this tells us when companies recognize revenue, whether it's recognized at the time that cash is received or if it's recognized when the good or the service is being delivered to the customer. We have the expense recognition principle. This is also known as the matching principle. We recognize our expenses based on when the revenue has been generated. I will go into deeper detail on both revenue and expense recognitions. And the fourth principle is called the full disclosure principle. This is where the financial statements of income statement, balance sheet, statement of cash flows, and statement of retained earnings are disclosed to all stakeholders involved. So looking at these principles just a little bit deeper, the two that we're going to focus on in this course in a very deep manner, one is the revenue recognition principle. This is where we recognize revenue. Now, some businesses use what we call a cash-based accounting system, and others use what we call a accrual-based accounting system. The cash-based system is really easy. We recognize revenue and expenses when cash is either received or paid. The accrual-based accounting system is where we recognize revenue when the good or the service is being delivered to the customer, or when the expense is incurred, meaning when it actually happened. So those are the primary difference between the two. We're going to talk very deeply about revenue and expenses at length in this course, and we're going to focus primarily on the accrual-based accounting system. A couple of assumptions we need to know when it comes to our businesses. One is called the going concern. Does the business have the ability to continue operating in the future? Next is the monetary unit assumption. Is it being measured in US dollars or the peso or the euro or some other currency? The time period assumption. We measure everything in accounting is measured either in months, quarters, semi-annual, or annual. These are also known as the reporting periods. And the fourth assumption is called the business entity assumption. Is it a sole proprietorship, a partnership, a corporation, C Corp, S Corp, or a limited liability company that it could involve one or more of those other ones? The business's organization comes into play to some importance because it depends on how taxes are impacting the business. With a sole proprietorship and a partnership, taxes are passed through to the individuals. When it comes to a corporation, the corporation itself pays the taxes, but the individuals are also taxed at their individual rates. So with corporations, we call it a double taxation. And then with limited liability companies, it's a pass-through entity typically, so the individuals are taxed, but the business itself is not. With LLCs, I always recommend LLCs if you're ever thinking about opening a business. With an LLC, all it simply means is that you individually, your assets are protected if the business gets sued. That's why I like LLCs. Couple of constraints to be aware of. One's called the cost-benefit constraint. This simply means that the benefit must outweigh the cost. It's kind of like you're going to school, right? The goal is you earn your degree to earn a larger income. That's the benefit. The cost is the degree, cost of the degree itself. The benefit must always outweigh the cost. Next is a materiality constraint. The information must be relevant and we can make decisions on it. And lastly, everything we do when it comes to estimates for cost, we follow very conservative practice. We want to make sure our estimates are very close to what we think reality will be. Next, I want to talk to you about probably the most important thing in accounting, and that is the accounting equation. The accounting equation is basically represents everything that we do in accounting. So this is a very, very important slide for you to remember. Especially for my accounting majors, you might want to print this one out and put this on your wall somewhere because you're gonna need to know this. All right. The accounting equation works like this. It says assets equals liabilities plus equity. I'm going to break down what each of these are for you real quickly. Assets are what the business owns. Assets are what the business owns. These are resources that we can use in order to help the business to generate sales. Okay. Examples of assets include accounts like cash, accounts receivable, which is when a customer owes us money, supplies, inventory, property, plant, and equipment. Those are all examples of assets. They're what the business owns to help us to generate sales. Next, we have liabilities. This is anything the business owes to someone else. When we owe money to someone else, it's a liability. So liabilities would include things like accounts payable, taxes payable, wages payable, loans payable, Short-term loans payable, long-term loans payable, bank loans, mortgage payable. Those are all liabilities. Anything the business owes to someone else is a liability. The difference between the assets and liabilities is called equity. Equity is what the owners of the business owns. Equity is what the owners of the business owns. Examples of equity would include things like the sales that the company made minus the expenses the company had to pay equals what we call net income, and that stays in business through what we call retained earnings. Retained earnings is a form of equity. And any investments that the owners made into the business minus any withdrawals that the owners took out of the business. All of those are considered what we consider to be equity. So a way to rewrite this accounting equation would be assets minus liabilities equals equity. Okay, that's the accounting equation in a very, very basic sense. We need to know that accounting equation because we have a lot of transactions in business, as you know. And every single transaction has an impact on the accounting equation. So I'm going to roll through a couple of quick transactions with you. Here's an example of a first transaction. Here we have an individual. Let's say it's a catering company, for example. Let's say this guy Kevin, right? So wants to invest $30,000 to start a catering business. Okay, obviously getting a catering business off the ground ain't no easy task. So we got to start with some money to make some money, right? So here we have an owner investing cash into the business. So the transaction would work like this. We would debit cash 30,000, cash going into the business, debit cash 30,000, and we would credit paid in capital 30,000 for the owner. Now, what this does, this one single transaction, every single transaction has two accounts, by the way. One we debit, one we credit. Every transaction has two accounts. Now, I want you to think about these two accounts for a second. Cash is an asset account. Paid in capital is an equity account. So what does that do to the accounting equation? Take a look. Our assets went up by 30,000 and our equity went up by 30,000. The accounting equation is still in balance. Assets equals liabilities plus equity. Only affected two accounts, but the accounting equation still balances, you see? The accounting equation will always be in balance. If for whatever reason it's ever out of balance, that means that an error has occurred. Here's another example, another transaction. Our company purchased $2,500 in supplies. Kevin, let's say that this is parchment paper or baking sheets, okay? So $2,500 in baking sheets. It's supplies for the business. We use the baking sheets to make money, right? So we consider that to be supplies. And supplies, Kevin, is going to be for you especially, things like baking sheets and parchment paper, foil, whatever's. We call those supplies in your business because they're designed to help you to generate revenue, sales. So let's say you spent $2,500 in supplies. The transaction you would make is you would debit supplies to increase your supplies, and you would credit cash to reduce your cash by $2,500. Hope you don't mind, Kevin. I'm just picking on you a little bit to
Yeah, you fine.
help make it relatable. So what does that do to the accounting equation? Our supplies went up, which is an asset, and our cash went down, also an asset. It nets out. It nets out because it's the same amount, right? So we can see that our assets is still sitting at 30,000 total. Next transaction. Here we have an example where Kevin decided to purchase some new ovens. Okay, new ovens. Kevin found a great deal on some ovens, $26,000 in cash. Sweet. Okay. So obviously, equipment is something that we need for the business in order to operate the business to generate sales. So equipment is an asset. So we're going to debit the equipment at its cost, 26,000, and we're going to credit cash, 26,000, because we're paying cash. And the impact on the accounting equation, 26 up on equipment and down on cash. Here's the fourth transaction. Kevin needed to purchase more supplies for his catering business, so we got some more baking sheets and parchment paper and all kinds of different supplies, and we found a great deal. We talked to a vendor, and our vendor's really cool, and they said to Kevin, hey Kevin, no worries. We'll let you buy 7,100 bucks of supplies on account, meaning Kevin's going to pay them later. Okay, so cool. That's our credit terms. So we're going to debit our supplies, 7,100 bucks, and we're going to credit an account called accounts payable. Now, because we purchased it on credit, that means we have to pay them back 30 days later. So our supplies went up 7,100, and our liabilities, accounts payable, went up 7,100. Accounting equation is still in balance. Fifth transaction, we provided some consulting services to maybe a different caterer, trying to help them out. Provide consulting services to them for $4,200 in cash. They paid us right away. Great. That's sales, right? So we debit cash because we received the cash, $4,200, and we credit sales revenue, $4,200. As you know, sales revenue is an equity account. So cash went up, equity went up. Accounting equation is still in balance. See how that works? And then of course we got to pay, we got expenses. We got to pay rent, we got to pay our employees. So I'm paying 1,700 bucks for my expenses. I'm going to debit my rent expense, 1,000 bucks. I'm going to debit salaries expense, $700. And I'm going to credit cash, 1,700. Now, what that does effectively is I'm showing my cash is going down and my expenses are going up. And as you can see, by doing that, my accounting equation is still in balance. Another transaction, we provided some more consulting services and we rented maybe part of our kitchen out for $300. Okay, great. So we're getting more sales, consulting revenue, and now we're getting rental revenue. Both of these are considered to be revenue. So we're going to, and our customer's going to pay us later. Okay, they're going to pay us 30 days later. So we're going to debit accounts receivable, which is an asset account, and we're going to credit our two revenue accounts, respectively. And as we can see, the accounting equation is still in balance. Then, a couple days later, our customer paid us. So we debit cash to increase the cash and we credit their account receivable, right? Because they ended up paying us. Great. So all we're doing here is we're moving it from accounts receivable into cash. Accounting equation is still in balance. Then later we're paying our bills. Remember, we made those purchases on account. So we're going to debit accounts payable and credit cash. And what that does is it lowers our cash and lowers our account receivable, our account payable. And then Kevin felt like he wanted to take 200 bucks out for himself. No problem than that, because he's the owner, right? So we're going to debit cash and credit owner's withdrawals. And there's the impact on the accounting equation. This slide right here shows us all of those transactions and how they affected the accounting equation. They all line up. Nice. So once I've made my transactions, I can then create my financial statements. I have the income statement, statement of owner's equity, balance sheet, statement of cash flows. These are 4 primary financial statements. Income statement shows your revenues and expenses. Statement of owner's equity shows changes in ownership. Your balance sheet shows your balances of all your assets, liabilities, and equity accounts. And a statement of cash flows shows changes in the levels of cash for the use of operating, investing, and financing activities. They all work together. And the way that they all work together is they're all connected through net income. Net income comes from the income statement. It's transferred onto the statement of owner's equity. It becomes ending balance owner's equity, which shows up on the balance sheet. And from the balance sheet, the cash total is represented on the statement of cash flow. So that's how those four financial statements are all connected. And then I'll briefly touch on this real quick. One trend is that companies are working toward to be more environmentally responsible, socially responsible, and incorporate more governance. But that's for another day. I just wanted to quickly highlight that. And the last thing we're going to talk about tonight is a ratio called the return on assets. This tells us how effective the company is at using our assets to help us to generate revenue. And the way that we calculate that is we take our net income and we divide that by average total assets. Now, anytime you hear the word average in accounting, we take the beginning balance plus the ending balance, then we divide by 2. And that's how we solve for the word average in accounting. Okay, so that brings us to the end of our first week lecture for our class. What I would like to just remind you of is, and this is what I'd like you to do for Thursday, is on Thursday, don't worry about coming to in-person class. Don't worry about meeting on Zoom. What I want you to do for class time on Thursday is go through everything we talked about tonight and go to your assignments. You have a Chapter 1 quiz to complete for me, and I'd love for you to do that on Thursday if you can. That'd be great. Are there any comments, questions, or concerns that any of you have?
How soon should we expect the recording to be on Blackboard?
I would say by tomorrow morning. I try to
Thank
do it.
you.
I try to do it as quick as I can. You're very welcome. Anything else? No? Awesome. Well, I just wanted to say thank you to all of you. I appreciate your all willingness to do class this way. And I'm looking forward to a wonderful semester together. If you ever need anything in the meantime, shoot me an email, call me, whatever. I'm here for you, okay? But
Sounds great. Thanks, Dr. B.
Great.
Thank you.
It's my pleasure.
Dr. B.
Thank you.
Thank you all.
Thank you, sir. Pleasure meeting you.
It's a pleasure. Yes, I look forward to it.
Dr. B.
Thank you.
Have a wonderful rest of your night. I appreciate all of you.
Also, take care.
Thank you. Good night.